Welcome everyone, and thank you so much for joining us for today's webinar on optimizing your finance operations through real-world benchmarking. My name is Fabiana Corredor, and I'm part of the marketing team at Oxys. As a reminder for all attendees, your microphones are muted. Should you have any questions, please feel free to submit them in the question or chat section, and we will make sure to address them during the panel discussion or at the conclusion of the webinar. Now, I'm glad to introduce you to our speaker and facilitator for today's session, Eric Libros. Eric leads the business transformation practice at Oxys, which includes a combination of both consulting and nearshore outsourcing solutions in the finance transformation, intelligent automation, and shared services space. Eric brings more than 30 years of experience advising CFOs and finance leaders on how to best design, implement, and manage their back office operations to achieve higher levels of efficiency, scalability, and true business partnership. His unique perspective as both longtime advisor and outsourcing operator provides practical, real-world insight to his clients that we hope you find valuable today. Once again, thank you all for being here, and now I'm going to hand it over to Eric.
Thank you, Fabi, and welcome everyone to today's webinar. This is actually the first of a two-part webinar series, with this session focusing on how to effectively use benchmark data to identify areas of opportunity and what strategies they can help you implement to improve your business operations. We're going to provide some real-world examples based on some of our experiences working with clients on how we were able to leverage benchmarks to identify those opportunities, what strategies they yielded, and then what the results were. We're also going to be conducting some polling questions to get your input on some of these topics throughout the course of the webinar. In the second session, which is going to be coming in April, we're going to be discussing what top performing companies are doing to improve their business operations, really focusing on the digital and operational solutions in the record to report, purchase to pay, and order to cash functions. And we're going to talk about some of the challenges that companies face in trying to implement these type of solutions and how to try to do that more successfully. But for now, let's start this session, and let's start by talking about a key challenge that's facing finance executives as they go into 2021, which is that there's just a lot of uncertainty out there as far as what's really going on and how to really plan effectively towards that. As you can see from some of the statistics here on recent surveys that were conducted, there's a lot of a lack of clarity in terms of what's the level of business is going to be in this year. Some executives expect it to come back during some point this year. Some are saying it's going to not until next year. The result of that is, should they be hiring? Are there more layoffs coming? And even in terms of spending, it's all over the place in terms of what people are thinking. So there's just a lot of uncertainty, which is requiring you to make decisions without having clear set of facts to base that on. One thing that is clear that people are looking at, however, is to allocate more resources to digital transformation in 2021. But even that has its own set of uncertainty, because as you can see from this statistic here, a lot of finance executives are planning to implement digital solutions, to implement data analytics and similar tools, but they're also expecting it to be very difficult to successfully achieve their goals with it. So if you're going into this year and you're making plans to implement your solutions and you want to drive performance and efficiency in your operations, there clearly is things that you need to be aware of to make that an effective program. And obviously, there are companies that do it well. So what we've seen from some statistics related to benchmark data is that world-class organizations, those are considered the top performers, have really maintained an operating cost that was 40 to 45% below the industry peer groups. And when they add digital technologies over the last couple of years, they're seeing an additional 15 to 20% benefit. So clearly, there's something that these organizations are doing that's more effective than what other organizations are doing. And the question is, what is it and how can you take advantage of that? Well, it really starts with benchmarks and giving you an idea of what's going on in your organization and where you fit in terms of the overall performance, and then what to do about it. And if you're going to use benchmark data, which we're seeing a lot of people being very interested in taking advantage of now, you really need to answer some of these key questions. How do you align benchmark data to your current business demographics? What is the right level of benchmarking performance for your business? Specifically, which metrics should you be considering when you're looking at your finance and accounting functions? And then what are the strategies and solutions that these metrics kind of give you the insight into, and how do you effectively implement them? That's what we're going to try to cover in today's session, and hopefully provide some further insights into how benchmarks can be a key tool to help you drive performance in your business. So let's start just by talking about essentially what benchmark data really means, which really is an organization looking at their performance using volumetric data and categorizing themselves compared to their industry peers. And typically what you're seeing is there are three categories that most benchmarking organizations provide. A top performer would be considered at the 75% and above performance level. A median performer, like the term kind of implies, would be at the 50%, and a bottom performer would be 25% and below. But when you look at this information, as I like to say, it's just math. It's basically volumetric, organizational, compensation type of data that's quantifiable and applied against a certain standard and then compared to others. What doesn't necessarily come in is the perspective on your specific organization, some of the complexities around that organization, and how that factors into how you operate today. You know, so for example, comparing a publicly traded consumer goods organization to a privately held professional services firm is going to have a completely different set of metrics, so that it's not a one-size-fits-all proposition. Similarly, if you're a $50 billion retail organization and a $500 million manufacturing organization, you're going to have different set of metrics as well that are going to apply. So complexity needs to be accounted for, and it's being driven by a lot of different factors, you know, things like size of your business, public, private, even some of the geography around it, and certainly within industries themselves, you see a lot of variance. So for example, here's something that you can kind of put some perspective around that. Last year, we were working with a $1 billion healthcare organization that had an accounting department of 33 people just focused on doing basic accounting work. Now, if you look at the median benchmark level, they were way above the bottom performer. I'm sorry, the median performer. Median performer for the healthcare industry and accounting for that size business was about 20 FTEs. They were at 33. So it indicates at the beginning that this is a company that really has some operational challenges, but is this an apples to apples comparison? Well, in this case, this client had about 70 clinic type locations located across multiple states that generated their revenue. So when you compare this to other healthcare organizations, if you're comparing it to, for example, an organization that has a few large hospital facilities, it's a very different set of parameters and that you're comparing. You know, one is more geographically diverse, has more operational regulatory complexities, has probably higher transaction volumes, and clearly will have overlapping staff at the various locations. So what you want to do is put some perspective around that and not just look at the data as a be-all end-all, but understand what's going on around that data. So we'll talk more about that and give you some examples of how that can apply. So when you start to look at benchmarks, the first thing you want to do is decide, where are you today and where do you want to be? And so most organizations, you know, kind of intuitively would say, well, I'd like to be a top performer. This is where I'd want to be. But let's look at what the characteristics of a top performing organization are and see if this kind of fits. So the characteristics of a top performer in finance and accounting would look something like this. They'd have consolidated, centralized, standardized business processes and systems. They'd have a limited number of transactional variations and exceptions, usually because they've simplified their business rules and made it a lot more seamless of a processing activity. And where they have a lot of manual work, they've often been able to implement digital or automation solutions that eliminate some of that manual work and make that process much more touchless or seamless, as the case may be. So the question you have to ask yourself is, does this sound like you? If this is your organization, then top performer is a good goal. But if it's not, then you really have to put yourself in perspective. Obviously, you don't want to be at the bottom, but medium may be a good place to be, depending upon where you end up. Here at Auxis, we like to use the term peak performance, helping clients achieve peak performance. And really, it varies. Peak performance is really taking your current organization and maximizing your capabilities and your performance within that structure without going and overhauling the entire operation. So once again, where you want to be requires some perspective and some thought, and we'll talk about how to apply that as we get into this. Which brings us to our first polling question. So, based on what you understand today, what I'd like to see if you could do is kind of benchmark your organization today. Where do you see your finance and accounting organization situate as it stands today? Do you consider yourself a top performer, a medium performer, a bottom performer, or if you're not sure and you need more information, please select that. So the poll, I'll let the poll be open, and Fabiana will run that process.
Yep, let's give it a couple of more seconds to get some more responses, and I'll close it in a second. All right, so I'll share the results. So interesting, 0% consider themselves a top performer, 73% a medium performer, 7% a bottom, and then the remaining 20%, they're not sure and they need more information.
Okay, that's interesting data that, we're going to talk about whether or not, give you some more information and see if that still holds. Are you medium, are you bottom, are you top? The top performer is a tough standard to try to get to. And, it's why, you see it as that level. A lot of organizations just aren't there. But let's talk about what it's going to take. So really what it starts with is the type of metrics you want to use to measure your organization. What we like to do is categorize them into two sets of data metrics, and you really use both of them to help apply across your business. One is an effectiveness metric and another is an efficiency metric. So
Eric,
yes.
Can you, for some reason, we're still seeing the results of the question. So can you quickly stop presenting and start presenting again so it can refresh?
Okay.
Yeah, sometimes it happens.
Is
there
this
you go.
Better?
Yes,
okay.
Perfect.
All right, thank you. So as I was saying, there's two sets of metrics that we typically use. One is an effectiveness metric and one is an efficiency metric. So effectiveness measures essentially the cost of the operation and the quality of the performance within that operation. So it's things like your total personnel cost to run a specific function, or it could be the total cost of operation, which includes other things like systems and other resources that are part of it. And then quality relates to the, could be accuracy, it could be how well the specific activities are being performed. Whereas an efficiency is more about productivity and really the number of people who are doing the work. So we're going to look at different sets of metrics like this that provide you with some guidance and look at specific data and see how that applies. But at the end of the day, it's important to compare organizations based on industry size and revenue. So the metrics we're going to show you are taken from an organization called APQC. It's a well-established benchmarking organization. APQC.org is the website. And if you're not familiar with them, I strongly encourage you to take a look. They provide some great resources for benchmark data. And what they use is benchmark data based on $1 billion in revenue. So that's kind of the leveling for all the organizations, and then you can scale it up or down from there. They have a lot of data that's in various industries, but what we're going to see is really kind of a more standard generic benchmark for $1 billion company. So let's take a look at what some of these data points look like. Let's start with the general accounting and reporting area and some of the key efficiency metrics that we talked about, the number of people and the productivity of those people, as you can see here. So when you're looking at a top performing finance and accounting organization based on $1 billion of revenue, it's roughly about 6 people who are in the accounting department. And as you can see, there's a big difference between that top performer and a bottom performer, almost 4 times the size of the organization between one and the other, and then obviously median kind of falls in between. Well, what's driving that are the types of activities that the organization is doing and the tools that the organization is using to do them. So if you look to the right, one good metric is the number of general ledger accounts that are being managed by per FTE. And as you can see, there's a tremendous difference between a bottom performer, where a bottom performing organization has a person managing 8 accounts versus a top performer who's managing over 300. How do they do that? What's the difference? It has to do with simplicity. It has to do with automation. It has to do with standardization. You know, there's lots of ways, and we're going to give you examples about that. But as you can see, this has a tremendous impact on how you can get there. Now, one of the things that you want to consider when you're using this type of information is how do I apply it and what does it mean to me? So when I see that let's say I'm a bottom performing organization, and I know that I have opportunities in some of these areas where I can increase the productivity, that's kind of my neon sign pointing to where I want to go. So, you know, you're looking at the fact that if I have 20 people doing accounting and the median says 10, I clearly have an opportunity to get myself from 20 to 10, improve my costs, improve my efficiency, but there are going to be things I need to do to get me there. So I use that secondary efficiency metric, the productivity measure, to identify where people are spending their time and then figure out what to do about it. That's kind of the message that you should take from this, is use these data as a kind of a signpost, and then figure out how to go deeper underneath it. But here's also another helpful hint. When you look at activities like reconciliations or journal entries, etc., what's happening is there's often a lot of these activities happening outside of the accounting department. So I'm sure many of your organizations, you have a lot of people who are not necessarily part of the general accounting team doing recs, passing through journal entries, etc. So you may not even get to the full scope of what's happening in these types of areas unless you do a little more deeper dive. And we typically do an activity survey passed out throughout the organization that allows us to really look at what the entire organization is doing, and then how many people are touching certain activities. You'd be surprised at the amount of fragmentation that exists in a finance and accounting department, and how many people touch certain activities like reconciliations, you know, budgeting processes, etc. We see that it's very common. So what you want to do is really get your arms around what's happening, because you can not only impact your ability to improve your accounting team structure, but even go outside of the organization and free up more resources. And again, we'll talk more about that. From an effectiveness perspective, now we're looking at cost, and we're looking at the accuracy and quality of the work being done. So as you can see, you know, a top performer versus a bottom performer, again, driven by the number of people doing the work, the cost is significantly higher at a bottom performer level. Again, this is for $1 billion organization compared to a top performer level. And you know what's happening here is a lot of this is being driven by the nature of the work that they're doing, and the accuracy and quality of the work that we're doing. If you look to the right, a top performing organization has a much better accuracy rate in terms of how they're processing journal entries with errors versus a bottom performer. 2% to 5% doesn't seem like a lot, and shouldn't have that much of an impact, but consider how many journal entries are passing through your organization, and is this really something that you can address and fix? You'll probably be able to improve not only the quality of the work being done, but eliminate rework and things that are catching up to you. So other good effectiveness metrics might be things like, you know, manual journal entries versus electronic, even the number of accounts in your chart of accounts. Simplifying your chart of accounts gives you a strong opportunity to improve the productivity and performance of your team.
Eric, one quick question from the audience. Can you define general accounting and reporting? Does it include FP&A, AP, AR, or just truly general accounting? And I know you're gonna.
This is just general accounting. We're going to look at AP and AR next, and FP&A would be considered outside of that as well. They all have different sets of metrics, but when you look at this organization here, this is people who are doing the close. They're doing, journal entries, reconciliations, all the activities related to essentially general ledger like type of accounting. So switching to accounts payable, here's some metrics that give you some insights into, what's the difference between a top and a bottom performing AP organization. So a top performing AP organization has about 3 people in it compared to a bottom performer closer to 15. Again, what's driving that? Look to the right. You look at productivity measures that are significantly different. A bottom performer has typically, the measure is about 5,000 invoices processed per year per FTE versus a top performer over 4 times of that. So how are they getting there? Well, it's about, again, you're going to see a lot of different things that come into play. It's about the process, but it's also about the technology, bringing in things like automation on invoice processing. If you're doing 5,000 invoices a year, you're likely processing a lot of that manually, versus if you're doing 20,000, there's definitely going to be some automation in play, whether it's EDI, whether it's an AP automation solution, whether it's robotics process automation. Touchless AP is going to be part of your business, and it's definitely going to be something that you're doing. So it's important to understand that there's different ways to look at this and different solutions. But at the end of the day, there's just a lot of different ways to measure this. Now, there are things that happen outside of the AP department that impact your productivity. So for example, if you're sending out invoices that need to be approved outside of the department, and you're waiting on people to get back to you, and that's causing delays in processing, it's going to have an impact not only to the processing efficiency, but also it probably will create more work, because what's happening is now vendors are starting to call in saying, where's my invoice payment? Either sending duplicate invoices in, you have to deal with managing those processes. So it's not just necessarily about the volume of invoices, but it's all the activities and processes that come into play. So the key is yes.
Sorry, so number of invoices, can you confirm if it's per month or per year?
That's per year.
Thank you.
Per year. So the key is trying to understand where you have a lot of people, what's impacting their productivity, and then going deeper and looking at what's really going on in the organization. It's not just about automating. It could be about process and activities that are happening outside. It could be your business rules. There's lots of things that would be considered. And once again, we'll give you some examples around that. And now if you're looking at effectiveness within accounts payable, again, the difference between a top performer and a bottom performer in terms of cost is significant, as well as the accuracy and effectiveness of the organization. 90% top performer matches invoice line items to a purchase order first time in, versus a bottom performer 55%. Again, what's going on there is there's probably things happening outside of the department. It could be in procurement, it could be in other areas where there's a reason it's not matching. And often to clean up an AP process, you need to go outside of the department and clean up the activities that are both the inputs and outputs of AP. So there's a lot of different ways to measure this and be effective with it. On the accounts receivable side, again, similarly, you're going to see very similar types of numbers. 4.5 FTEs is a top performer, about 20 is a bottom. So again, you see big discrepancies. Look at the cash receipts, number of cash receipts processed per FTE. That's and again, annual number, but that's a dramatic difference. A bottom performer processes about 2,600 versus a top performer over 20,000. What's the difference? It's probably going to be automation, but it's also going to be things like, is your customer giving you detailed remittance advice. Are they taking credits and adjustments, and you have to figure out what's going on? All of these things have an impact to how well and effective you're going to be processing. So you need to pick up the covers, look underneath, and figure out what's going on. Even your own organization can have an impact. How many times have you seen something like this, where a sales organization gives a customer a discount? It doesn't match the payment, the invoice in the system, but the customer got the discount and paid the discounted amount, and this all happened outside of the system, and you have to figure out why that happened and chase people down to get the answers. All of these things, if you clean that up, you're going to be able to be more productive and efficient. So these metrics have a lot of different factors that come into play, and then here's some examples of other metrics that you could use, but these are the ones that we typically focus on. And again, in terms of effectiveness, you're seeing difference in cost. Again, very significant, but look at the total cost to process a customer receipt. That one is really dramatic. Under $4 for a top performer compared to $42 for a per receipt for a bottom performer. Again, so many ways to clean this up, and we'll talk about that, but it's really important to understand when you look at your business, what's going on, what's driving this, and what can I do about it. So that brings us back to our second polling question, which really is a repeat of the first. But what I wanted to do was kind of see if having seen some of this very specific data, did it change your perspective at all? So I'm going to put it out to the audience to respond, and just curious to see if anybody who's thought they were a median, maybe they're moving themselves to a bottom, or maybe they're moving yourselves up. I'm curious to see this change any of your perspective.
Yep, let's give it a couple of more seconds. Interesting, because I think now people are not sure as they were before. So that's part of what we're probably gonna see. All right, so I'll share the results. So now 7% of them consider themselves a top performer, 60%.
Wow.
Yeah, 60% a medium, 13% a bottom performer, and now 20% are not sure.
Well, that's interesting. I'm glad some of you feel like you're doing better than you did before, and then others are, saying, well, maybe we need to look deeper. But that's interesting. I think that was a good exercise. Are you able to see my screen with the changing, or is the polling question?
Yeah, it's working now.
Okay, great. All right, so what we're going to do now is we're going to go through some very specific examples. These are actual clients that we worked with, where we use benchmark data to identify issues and then operational strategies that would help resolve some of the issues, and then what the results were. So we're going to give you some good examples around that. Hopefully this will put some of this, what we're talking about, into better perspective. So let's start with our $1 billion healthcare organization that we were talking about before. As you recall, some of the characteristics of that business was, very geographically diverse. They had 70 locations. They had 33 people just doing the accounting work, directs, etc. Each location had about 40 to 50 GL accounts that needed to be reconciled on a monthly basis. So if you do the math, that brings you to a total of about 3,000 GL accounts that had to be reconciled monthly. Now, a big driver for them was they were planning to do additional acquisitions, grow the business, and they wanted to try to scale without having to just keep throwing bodies at this type of work, and improve the productivity of the organization. So if you, again, going back to what our benchmark data showed, the median performer in their industry was about 20. So we knew that there was an opportunity there to get from that 33 maybe down to the 20. But here's an interesting point. If you look at the median performer for managing GL accounts, it was about 55 roughly. So if you do the math and say 3,000 GL accounts and 55 accounts per FTE, that actually is telling you that they needed 54 FTEs to manage the volume that they were working with. So the question becomes, are they doing better than you would expect that they would be doing? Or do they need to hire more people instead of trying to reduce the head count? Well, here's the reality of the situation. basically the accountants weren't reconciling every account every month, even though that was what they were tasked to do. There was considerable time being spent cleaning up issues with unreconciled accounts that carried over from month to month, creating numerous journal entries to resolve the variances. And all of these errors that they found required rework and extensive oversight. So managers were basically not really looking at anything more than cleaning up the activities that people didn't get done in the prior month. What happened was the accounting organization was really spending all of its time reconciling, correcting, and updating. There was absolutely no time for anything else, and their closing cycle was really tight, and they had to turn things around quickly, and they had absolutely no time for any type of analysis, any type of inputs to the business. It was a really what I like to call a vicious circle of transactional work. So what were the solutions? So we took the data that we got from the benchmark and said, all right, so we know there's an opportunity in accounting. We know that they're not being, that there's something going on, that they're not really looking at all the accounts, even though that was what they were supposed to do. So we said, how do we address that? And we went a little bit deeper. And we said, all right, what do we need to do? Well, the first thing we noticed as we kind of dove into the organization was this was a company that had acquired a bunch of different businesses. They had clinics in different areas, and they pushed it together. But what they never did was they never standardized the account structure across all of them, nor did they standardize the reconciliation process. So it was non-standard, which resulted in people having to do different processes and understanding different structures as they dealt with different sets of clinics. So this not only slowed them down, but it created errors. The other thing that we kind of said was, you don't have to reconcile every single account. Focus on the material ones on a monthly basis, and then use the other accounts on a more periodic basis, say quarterly, but make sure you get them done, because otherwise that's going to start adding up and carrying over too. And very importantly, look for an automated account reconciliation platform. So all of this work, those 3,000 accounts that I was talking about, was being handled manually through Excel. You all know what that's like. You all know how hard that is to get, clean that up and get that done. Well, there are these platforms out there. There's, some of them are very well known: Blackline, Trintech, OneStream. These are examples of them. So we recommended using them because essentially what those platforms do is when you get all the inputs to the various accounts, if it will look at the accounts, and if things match, it will just clear them out. You don't even have to look at them. And if it doesn't match, it sets it aside as a variance, which is what the team would focus on. But typically it takes it a step further and says, this is a variance, here's what the variance is, and here's where I think it is. So you still have to look at it, but you spend a lot less time researching, a lot less time working on things you didn't need to work on. So what this allowed us to do was free up people to do other things and ultimately restructure and streamline the entire accounting organization. So this is what was the result. They went from the 33 FTEs down to 19 FTEs, and it was a complete restructuring of the team. Previously, everybody was doing everything. Everybody was touching every type of activity. They were assigned to specific clinics, but they weren't necessarily focusing on specific tasks within that. So we set up a team to do reconciliations. We set up a team that was just providing some QA and oversight. We set up a reporting team and a fixed asset team, and essentially allowed us to reduce down to the 19. And by using the tools and technologies we've talked about, they were actually performing at a top performer level for reconciliations and journal entry processing, and they had a much higher degree of accuracy and efficiency in the closing process. So, what you're seeing is it's not rocket science. It's a lot of it's basic blocking and tackling, but until you take that step back and say, where's the opportunity, you don't even have the chance to breathe and look at how to solve it. So, we showed them, that what they were doing, we showed them what the challenge was, and it allowed us to help them put together a much more effective structure. Another example that I wanted to share has to do with a different type of business completely. It's about a $600 million consumer goods company. And this is a company that operates in 7 different countries, so multinational operation, where each country had its own finance and accounting team. And usually you find that when you have a structure like this, because each country has its own set of unique regulatory requirements, tax, accounting related requirements, etc., that requires the team to focus on those specific activities. So the idea there was they wanted to reduce their operating costs, and the question was, do you have a decentralized operation like this? Will bringing it together under a shared services model make sense? That was what we were being asked to analyze. So if you look at some of the key benchmark information, they currently had 110 people across all functions within finance and accounting. That's GL, AP, AR. Okay. The benchmark for a company of their size, bottom performer, was just under 50, 49.2. So as an organization, they were more than double the bottom performer level. So we knew that there was an opportunity there. But even more dramatically, if you looked at the record to report function, general accounting related activities, they were actually 3 times the bottom performer level, where of the 110 people, 57 were actually doing accounting related work compared to the benchmark, the median benchmark of 18. Okay, so you have, I'm sorry, that's the bottom performer benchmark. But so that clearly tells you that there's an opportunity. So how do you quantify that and decide if this even makes sense? So typically, if you go through a shared services type of initiative, you can expect to get at least 10 to 20% in synergies just by consolidating these geographically diverse business operations. Typically, what's happening is you have overlapping people doing similar tasks, and by bringing it together, you can eliminate typically about 10 to 20% of the people, because you're able to consolidate and get more efficient doing it that way. It also means you would look to standardize how you're doing it, because typically you're going to see it being done differently in different markets. You do have to account for the localization, the local requirements. So you bring in solutions that specifically address those local requirements, but then in their case, they were doing a ton of manual work. So we also said, let's look at additional technologies such as automation tools that could provide, and often we see about 20 to 40% of additional headcount reductions. So the question is, do you do this initiative? Well, this type of initiative is it has risk because you're changing your business operation, but it also has a lot of cost and it takes time. You have to bring in a lot of different organizations under one roof. You have to bring in new technologies. There's risk, cost, and time that come with it. So is there enough of a return on investment to make these investments? That's what we were being asked to do. So this was a high-level analysis that said, tell me, in a very, quick and easy way, do we go deeper? And so what the analysis showed was that of the 110 people that they currently had in the organization, if you looked at what you needed to retain in market in those 7 different countries, typically you're going to need to retain 1 or 2 people per location to deal with local regulatory requirements, tax agencies, local audit support, local accounting requirements. So if you looked at the 7 markets, we assumed we would keep 2 people per market. That puts 96 people in play. Now, assuming we can get our 20% by consolidating, that's about 20 FTEs that can come out of the organization right off the bat. Then the next piece was, can I get my 40% through process optimization, standardization, and automation? That's the big prize. Another potential 30 FTEs could be achieved. So if you look at where the model ended up, and this was a model, they were currently at 110. The bottom performer was at 49. We were able to build a scenario that showed them getting to about 47. So there's still a bottom performer level, but the reality is, because of the complexity of their business, because of the fact that they're operating in various countries, you're probably not going to be able to do much better than that. But it's a significant difference from the 110 that they had. It's about 50 FTEs. So if you look at the math there, it's about $2.5 million annual cost savings. So what this told us was, if you go through this initiative of shared services and a process optimization and automation, the size of the prize would be about $2.5 million. It was worth a deeper look. So really, at the end of the day, what we told them was, now what you need to do is see where it says assume that 40% can be reduced, figure out the specifics of how to get there, dig into the operation, look at the processes, and come up with the specific answers there, and you'll determine if that makes sense. But even this exercise gave them the insight to say, we want to look at this and see if this is even a viable option for us. This brings us to our next polling question, which, we wanted to ask you, from your perspective on your business, where do you see the opportunities and challenges in your organization? And what you can do here is pick from, any of these, and you can pick more than one, but do you see the biggest operational challenges and therefore opportunities in general accounting and the closing process? Is it in accounts payable, accounts receivable, reporting and analytics? Curious if you have a good perspective on that right now. So I'll open it up to the poll and let Fabiana read the results.
Perfect. It's still in process. So whoever has an answer, we would love to hear from you. Okay. All right, so I'll close the poll and share the results. So by far, accounts payable is the one where they're experiencing most of the challenges with 58%, followed by general accounting with 42%, accounts receivable with 33%, and reporting and analytics with 25%.
Yeah, and that's very often in line with what we're seeing. A lot of organizations, AP is the area where people, it's the one that has the quickest return on investment. There's typically a lot of quick wins there. Where it gets tricky is the accounting area. So can you improve the closing cycle? Can you cut down on the work that's being done? Because the goal of all of that isn't just to get more efficient and accurate, but it's really to start freeing people up to do other things. More analysis, more insights into what's going on in the business. We talk a lot about the term modern finance, and what's happening is accounting organizations are being asked to provide more insights into the business, not just report on the results. So the only way you can really effectively do that is to cut down on the activities that are taking up most of your time, the closing process and the related activities around that. So that's a common area as well. But seems like there's a lot of opportunity in all these different organizations. Final example we wanted to walk you through, and it's a little bit more involved, so I will spend a little more time with this one. This is a $2 billion global manufacturing company, and they wanted to analyze, was it an opportunity to create a global shared services model? So the basic business characteristics were this. They had 8 locations around the world, all tied to manufacturing plants that they had in different markets. Some of these markets were in high-cost locations like North America, Europe, and Australia. Others were in very low-cost markets like Latin America, Africa, and Asia. Each of the finance and accounting teams was exclusively focusing on their local finance operations and managing very specific market regulatory requirements. Now, the company had essentially every market operating differently. They were non-standard processes from market to market, and the systems themselves were not standardized, and every market had a different set of systems. But what the company was doing was they were in the process of standardizing processes and systems by bringing an ERP across the various markets and implementing them. But they were having a hard time getting there. They were struggling to get the system implemented effectively. The reason for that had to do with they had highly tenured teams, localized requirements, and variances that were impacting the ability of the system to be standard, so you had to account for the localizations. But you also had a team of people who were so used to doing things in a certain way that they were resistant to change and not really cooperating effectively with the process of standardization and systems implementation. So it was a difficult situation for them because they knew they needed to improve operations and they wanted to get more efficient, but a lot of factors were getting in the way. So you know, you can, if you look at where they were, this was another interesting data point. So when we did the analysis, and what we did for them was purely a data-driven analysis that said, let's look at each market and let's look at how they're performing in each market to see what kind of shakes out from there. So overall, within finance and accounting, they were actually pretty good. They were at about 65 FTEs compared to the median benchmark for a company of their size, which is 75. So you would say, wow, they're in decent shape when it comes to the number of FTEs. They're actually working pretty well. But then what we saw was when you look at the cost of the operation, that's where it got interesting. So the gray bar here to the right is their current cost. The median bar is the yellow one, is what a median performer does. And as you can see, it's over $1 million different. Even though they had less headcount, 65 compared to 75, their cost was about $1 million higher than the median performer. What was driving that? Well, this was really surprising because they were operating in some low-cost markets. They were in Africa, they were in Asia, they were in Latin America. So it's not like you're only looking at high-cost market conditions. So you would expect the cost to be lower, especially if the headcount is going to be lower. So the initial analysis told us that, you know, from a head perspective, they probably weren't that far off, but we knew that there was an opportunity because their cost was high. So we knew that there were things we had to focus on, and ultimately we were going to be able to reduce their headcount further in order to get them to where they needed to go. So this was a combination of looking at the organization, looking at the process, and remember they were implementing a system to standardize, so we knew there was going to be an impact from that as well. Now, so what we did is we looked at the specific functions, and we saw that in the accounting area, they were kind of performing at a median level. It really wasn't that much of a challenge. But when you looked at AP and AR, as you can see here, in both cases, they were performing below the median, approaching bottom, and in the case of AR, way below the bottom performer level. So we knew that if you focus on these functions, accounts payable, the gray bar here to the left, and the gray bar here to the right, this is telling you that there's a lot of opportunity to improve in those areas, and a lot of opportunity to get where you need it to go. But it's also, you know, was curious because even with that, why was their cost still higher? It didn't make any sense. So we knew we needed to look at AP and AR, but the other thing that we said was, I think there needs to be a review of the organization itself. Remember, this was a highly tenured organization. And what happened was, even though they were in low-cost markets, if you're paying the same people year over year over year, an increase from one year to the next to do that same level of work, you're essentially overpaying for the work that you're doing. So when you compare it to a benchmark, you're comparing somebody who's been doing the same work for a long time. They're being paid higher for the role that they're performing than what the benchmark would tell you. The other thing that we typically see is this leads into span of control issues, meaning that you have people in an organization that you know, are not necessarily structured exactly the way you'd want them to be. You know, in a typical organization, maybe you have a manager or two with a staff of 8 or 10. In this case, we were seeing 5 managers and 3 staff. So you were paying these people more, and at some point you had to promote them to a manager level, even though they weren't necessarily doing the work of a manager. So these two issues, tenure and span of control, plus, you know, that the resistance to the change was what we needed to attack in order to solve the problem. So in the end, by standardizing the process, which was needed to be done for the systems, centralizing, bringing those people together and getting the synergies that come with that 20%, and then bringing in additional automation to solve some of the manual activities that were being done, we were able to reduce 12 FTEs across all markets. Now remember, they were above the median level, so reducing another 20%, almost 20% of heads, was actually a pretty dramatic change, because you wouldn't have expected to be able to get that much out of the organization. We were able to free up another 12 FTEs to take them from, if you see here, the kind of the burgundy bar, 53 heads compared to the 65. They're now approaching the top performer level, which is 46. okay? But then the other thing that we saw was that this gave us a cost improvement of about roughly $600,000, for the savings that they were looking for. But remember, this is where that 10-year / span of control issue was coming into play. So what we said was, there's something else that needs to be done here. So in order for them to truly restructure the organization, reboot it, in essence, and lower their cost, that we proposed an outsourcing model, which would create a hybrid model with key roles retained in market and all the transactional work being shifted to a nearshore location. And ultimately that drove an additional $700,000. So in this case, the combination of process standardization, automation, restructuring of the organization, and outsourcing got them not only to almost a top performer level from a headcount perspective, but got them well above the median performer in terms of the operating cost, and resulted in about $1.3 million in annual savings. So a significant benefit for the organization, really even more than what they were looking for. Brings us to our fourth polling question, last one, which, we've talked about different solutions that are available. And I'm curious, and you can, again, pick more than one here, which potential solutions would have the biggest impact on improving your finance and accounting operations? Is it something as simple as process standardization and simplification? And no, that's not simple, even though it sounds like it is. Is it bringing in automation to automate manual activities such as RPA or other tools? Would it be a centralization / shared services initiative to gain that kind of synergy level that we're talking about? Or would outsourcing some of the non-core activities make sense for your organization? I'll turn it over to Fabi for the poll and the results.
Yep, I'll give it a couple of more seconds. We have most of the responses already submitted. Right. So 88% believe that automating manual activities is the main way to get those efficiencies, 69% through process standardization and simplification, 50% through centralization and a more structured shared services model, and only 6% outsourcing non-core functions.
Okay, so it's interesting that the automating manual activities got the highest level, but it's usually a combination of the first and the second, process standardization and simplification, because if you're going to automate, you probably are going to need to standardize and simplify the processes to a certain extent. So it's something to consider, that it's not just a one-off type of activity. You don't just plug automation in. You're usually going to have to refine your processes, often simplify them. But the end result is clearly that it's an activity that will drive and improve some of your operations. So just to kind of wrap up, if you're looking at
I have some questions that I just want to make sure that we have time to cover. Should I bring them?
This is one of the last slides. So let me just wrap this up and we can jump into some questions. So if you're looking at benchmarking as a tool for your organization, it needs to be part of a broader framework. So benchmarking is not a one-off. As we've talked about, it's a data point. It gives you indications. It helps you understand where you're going and where you are and where you can get to. And it helps you define things like business case. But what it really should be is part of a broader continuous improvement program. So you use the benchmarks to identify the opportunities, measure the performance, identify what the expected outcomes are, and then to measure to see if you got it. But then you should repeat that process. So it's not something that you want to repeat, every 3 or 6 months, but likely every couple of years. It's a good exercise to revisit, because things change, your organization changes, new technologies come out. You want to see what else you can do to keep your organization nimble and productive. So benchmarking is a great tool to give you those insights, but it should be part of a broader continuous improvement program. So just to summarize, as we've talked about, benchmarks can give you some great insights into the current state of your operation, but it's also it's that roadmap that tells you where are the opportunities and what should I be looking at. It's not standalone. It just gives you, it's a data point, but it gives you some real good insights into what you want to do. It's the first step in a broader analysis, and given where you are as an organization today, and we're seeing that from a lot of companies asking us about this, this is something that you should do as your first step, but then have it be part of a broader initiative to drive performance and efficiency in your organization. Some of the strategies we've talked about, shared services, optimization and standardization of processes, automation, digital transformation, outsourcing, all of them can come into play, and you need to see where you want to get to, and then which strategies make sense to fit into that. And then lastly, it also helps you define your business case. If you're going to make some of these investments, it's going to give you what your expected end state would be. It gives you your target, and you can use that to drive your future state and your business case. So all of these pieces around benchmarking help to provide you those insights. So that concludes the content of the webinar. I'll throw it open to questions, but what I wanted to just offer real fast was, if anybody from this session is interested, we can conduct it's going to be high level, but it's a complimentary assessment based on some benchmark data. We'll ask you for some information. We'll give you some indications back about where you sit and what maybe some of those opportunities are. So I recommend reaching out to us, and we'll provide more details around that. But there's no cost for that. It's just to really help you get started on this journey. And the other thing I wanted to mention was there's a white paper, a companion piece to this webinar that's available on our website that provides some of the same information and some more details. So I encourage you to go to our website, and you can download that to get that information. And with that, I'll turn it back to Fabiana and see if there's any questions.
Yeah, so I think that you kind of answered this question. If we want to get APQC benchmark data for our organization, do we go directly to them, or can you provide that data?
You can go directly to APQC. You have to, you have to become a member. For end client organizations, there's no fee for that. For professional service firms, there is. But if you're a business, you can go and register with them, and you'll see a lot of available data. How they really work is you provide them with data, and they'll give you data back. So they're going to ask you for a series of volumetrics and other data, and then from that you'll get data back based on the data you give them. So that process sometimes can be challenging and cumbersome for organizations to do. So we can help with that. We can provide it, or I can give you through this exercise some high-level answers to those questions.
Great. So this question, if I'm already running very lean, but my team is located in a high-cost US market, seems like the only way to be more cost-efficient is by moving to a lower-cost location. What would you suggest in this case? Can you talk a bit about the nearshore market in Latin America that I understand is one of your areas of expertise?
Yeah, so that's a great point. So at the end of the day, if you're running lean and you're doing all the right things, there's only so much you can squeeze out of a stone, right? You're not going to be able to get that much more efficient. So at some point, it comes down to cost. And if you're looking at various cost models, there are different locations that provide different solutions. So what we work extensively in Latin America, and there's a number of different markets in LATAM that provide lower cost options. What we typically see, our center is located in Costa Rica, which is considered the #1 nearshore destination, and has a very robust business services market with more than 170 multinationals having operations there. So typically in Costa Rica, you're seeing anywhere from 30 to 50% cost savings. That's a good opportunity, and that's through a BPO model. It's even a little bit higher if you try to do it directly. Other markets in Latin America can be even lower cost. Colombia wouldn't be surprised to get another 20 to 30%. Mexico, the same. The challenge is there's only a few markets that you're really going to probably look at, and if English is a requirement, you have some limitations because not all markets are as robust in the English skills. Costa Rica by far is the #1 market when it comes to English skills. So it's a great location. You could see 30 to 50% savings there. and other markets might provide additional, but the challenge would be English skills.
Awesome. And then regarding AP, it says for AP specifically, what are the typical efficiencies and savings that you're seeing after implementing RPA, and what are the specific processes where you're implementing it beyond invoice processing?
So with RPA, as a general rule of thumb, we're seeing, we had talked about 20 to 40% cost savings / productivity gains. That's what we're seeing. So, it's not uncommon to get to that 40%, but again, it may not be across all different areas of AP. Certainly around invoice processing, that's a main area that we use RPA for, along with some other tools like intelligent data capture to essentially handle the indexing and a data extraction piece, and then pass it off to RPA. But we also use our automation for things like invoice coding, for example, or vendor master data administration. Even doing some work around reconciliations. There's tools that we provide, vendor statement reconciliations, and then lastly, even vendor inquiries can be, there's some degree of automation. That's usually a big pain point for a lot of companies because it's hard to manage. We provide a solution that at least allows us to track and report on that. And then the biggest thing that you can also get is having you use all that information and present it back to you so you understand what's going on. Having much more clarity around the business, the insights that drives gives you a sense of where you are for your cash, where you are for, with vendors, what are you taking advantage of discounts. These are all things that often get lost in the accounts payable shuffle. We use automation for pretty much all of those different areas, but clearly the number one opportunity that most organizations look at is invoice processing.
Awesome. Thank you, Eric. So I believe that with this last question, we have finalized our webinar today. There were a couple of others that we didn't have time to address, but we'll make sure to contact you in private to have a discussion. And, a lot of you asked for a copy of the presentation. We will be sharing a copy of the full presentation and the recording of the webinar afterwards, probably tomorrow morning. So look forward to receiving that. And once again, thank you so much for your time today. And I hope that you found it valuable. Thank you, Eric, and have a great rest of the day, everyone.
Thank you.